Good afternoon and welcome to our webinar, Growing Fee Income with Foreign Exchange Hedging and International Payments. I'm Terrence Richardson, Head of Communications at Derivative Path, and in today's session, we'll explore how your institution can boost fee income and improve your customer experience by proactively offering FX hedging and payment solutions to your customers. Before we get started, I'd like to cover a few housekeeping notes. Today's webinar will run for approximately 30 minutes, followed by a brief Q&A session. If you have a question, please feel free to submit it, and we will respond to as many questions as we can as time permits at the end of the presentation. If you encounter technical difficulties, please use the chat for assistance or email us at info@derivativepath.com. Today's session will be recorded and all attendees will receive a link to access it afterwards, along with the slides from today's presentation. Additionally, we're providing a PDF reprint of a relevant article from Great Lake Bankers, November 23rd issue. It's available for download in our resources section. Post-webinar, look for a follow-up email with further resources and contact information. For more insights and updates after this event, follow us at Derivative Path on LinkedIn or visit our website at derivativepath.com. Now, let's turn the opportunities that FX hedging and payments offer to the U.S. commercial banks. We're joined by two professionals with deep experience in helping banks with their customers manage their currency risk, Matt Blangiardi from our FX International Payments Solutions team, and Chris Slusher, head of our bank solutions at Derivative Path.
Thanks, Terrence, and good afternoon, everyone. In the current challenging lending environment, our bank partners are looking for new ways to grow fee income. One opportunity that many are exploring in the current environment is offering FX hedging and payment services. When we initially bring up the topic of FX with our bank clients, we usually get one of two reactions. The first, FX is strictly the domain of large global banks. What does it have to do with me? Or two, it's not relevant for my middle market clients. As we'll see today, both of those assumptions may not necessarily be true. In today's session, we're going to review the case for launching an FX business. For those that aren't familiar with the market, we'll provide a quick primer and review the industries and geographies that are most active in FX. We'll also review the two major opportunities for banks in the FX market, FX hedging services and FX international payments. And we'll wrap up with some thoughts on how you can evaluate the potential opportunity at your own institution. The FX market is the world's largest and most liquid market, with an average trading volume of a staggering $7.5 trillion. For perspective, that's 25 times the daily average trading volume for the US equity market. If we look at the composition of that daily trading activity, over half of it is FX swaps, which are short-term agreements to buy and re-exchange a currency at a future date at a fixed exchange rate. Another quarter of that volume is spot transactions, which are transactions to buy or sell a currency for 1 or 2 day settlement. The remaining volume is allocated amongst forwards, FX options, and currency swaps. If we look at the most actively traded currency pairs, 88% of all currency transactions involve the US dollar. The most common pair is the euro, followed by the Japanese yen, the pound sterling, and the Chinese yuan are among the most actively traded currency pairs. While much of the trading volume in the FX market is between speculators and day traders, the volumes that we're going to be concerned about for this exercise is primarily international trade. International trade is a huge portion of the US economy, making up about 25% of GDP. We look at the largest trading partners of the US, the largest one is Mexico, followed by Canada, and in third place is China. So many of the FX flows that we see with your clients will be in one of these different currencies. Looking at the major exporters in the US, among the largest industries are transportation, chemicals, computer and electronic products, oil and gas, and machinery and petroleum. International trade occurs across the US. If we look at some of the largest states that are active in international trade, Texas leads the pack, representing over 16% of international trade in the US, followed by California, Illinois, New York, Michigan, New Jersey, Georgia, Florida, and Pennsylvania. Generally, our bank clients think of international trade as being an activity that's primarily confined to large companies. But the reality is that many small to medium-sized businesses are active exporters and importers. In fact, 91% of the companies that import or export have less than 100 employees, and 76% of them have less than 20 employees. When we talk to smaller companies about foreign exchange risk, many of them have the impression that because they do their business in US dollars, they don't have any currency risk. However, in fact, any payment that crosses a border does involve currency risk for one of the two parties. By engaging in US trade in US dollars, essentially the US company is pushing that currency risk onto their foreign supplier or onto their foreign customer, and potentially putting themselves at a competitive disadvantage because that foreign supplier must manage the currency risk on their end. Ignoring this FX risk can be costly for US companies. Companies that transact only in US dollars may pay more for their imported goods, or they may miss foreign sales opportunities. Because if you're paying in US dollars to a foreign vendor, typically that vendor is going to build in a premium to bear that currency risk. Or if you're receiving US dollars from a foreign customer, you may lose competitive advantage by being outpriced by local competition that is willing to price in the local currency, making your product prohibitively expensive in local currency terms. As we mentioned earlier, there's broadly two different types of opportunities for banks in the FX market. The first is FX hedging services. FX hedging services involves providing customized hedging solutions to businesses or individuals to protect against currency fluctuations. Typically with FX hedging services, these are larger transactions and may entail a full range of products, including spot transactions, forward contracts, window forwards, and FX options. Typically, these are longer maturities, up to as long as 10 years, and they're generally executed over the phone, and because of their longer dated nature, may involve some counterparty credit risk. On the other end of the spectrum is FX international payments. These are typically involved with securing efficient cross-border payment solutions. Generally, these are smaller transaction amounts. Often they're spot transactions that are settled in 1 or 2 days, and these may be executed through your wire room or white label portal. Typically, because of the short-term nature of these transactions, there's little or no credit risk involved. So if we think about the benefits of launching an FX hedging and payments business from the bank's perspective, it creates an important source of non-recurring, non-interest income that boosts the relationship returns with your clients. It also provides an improved and integrated customer experience, allows you to take greater control over pricing your customers' international transactions and retain a larger share of the fees that these activities may generate. It also allows you to expand your toolbox by offering an expanded range of solutions that your bankers can provide to your customers, and enhances the bank's reputation as a sophisticated provider of capital market solutions. It also allows you to distinguish yourself and compete more effectively against those larger banks. So let's take a little closer look at FX hedging services. So when we think about managing foreign exchange risk, there are a number of typical tools that are used to manage exposure, including spot contracts, which is an agreement to exchange currencies at a pre-agreed exchange rate for 2-day settlement, forward contracts, which are an agreement to exchange currencies for a future date, or currency options, which is a contract in which the buyer of the option pays a premium for the right to exchange currency at a pre-agreed exchange rate on a future date. The clients that typically use these types of solutions would be importers or exporters with recurring cross-border sales, even if those sales are dollar denominated, or they could be businesses with significant overseas earnings or investments, or businesses that have planned CapEx expenditures where they're buying a product or machinery from a foreign vendor. Among the items to consider is that FX contracts can be cash settled, or they can be physically settled through the delivery of currency. Typically, FX contracts, especially longer dated ones, will involve some credit risk, both on the settlement of that FX contract as well as the forward risk associated with entering into longer dated contracts. Let's take a closer look at using FX hedging products to help a client manage FX exposure. In this first case study, we're going to look at a scenario of a cross-border M&A, where a client is selling an interest that they own in a European company. Given that the sales price was denominated in euros, the client is concerned that the euro may weaken against the US dollar. One additional complicating factor is that the client was uncertain about the timing of when this transaction was going to close. As a solution to this problem, the client was offered by the bank a window forward contract that enabled them to lock in a fixed exchange rate for converting euros into US dollars. This solution allowed the client to protect against a weakening euro by locking in an attractive exchange rate for converting their euros back into US dollars, while also retaining flexibility about the timing of the settlement. This enabled the bank to generate significant non-interest income without having to set up any foreign currency nostro accounts, and also allowed the bank to solidify its relationship with an important depositor. In our second case study, we're going to look at foreign capex, which is another common example of an FX risk that clients like to hedge. So in this case, we had a Northeast-based packaging manufacturer that was purchasing manufacturing equipment from a European supplier. Given that the purchase price for this equipment was denominated in euros, the client was concerned that the euro may appreciate against the US dollar, making it more expensive in US dollar terms to purchase the equipment. In this particular case, the client had several payments due throughout 2024, but again was unsure of the exact timing. In this case, the bank offered the client a series of 2-month window forward contracts, giving the client the ability to lock in a fixed exchange rate for their euro purchases, and that could be settled anytime during that 2-month window. This series of forward contracts, which the client entered in today, allowed the client to eliminate this currency risk over the coming year, protecting against a strengthening of the euro and locking in an attractive exchange rate while still having that flexibility around the timing of the settlement. It also enabled our bank to generate significant non-interest income on the transaction. So we're going to change gears now and pass the baton over to Matt to talk a bit about the landscape for FX international payments and some exciting developments in that marketplace.
Thank you, Chris. Actually, I'll pick it up here for us. We're going to move from the target market and FX hedging services into a discussion about the FX international payments. I'm joined by Matt Blangiardi. Matt has been in the FX payment space for over 20 years and brings a wealth of experience into this discussion. Let's dive in, Matt. Can you tell us about the current state of FX payments?
Certainly, Terrence. As this slide kind of, and hello, everybody. As this slide kind of mentions, banks have found themselves primarily for reasons that are out of their control, at a bit of an inflection point. And the only time I've seen anything like this was we look back to like 2012, 2013, where the entire industry was trying to cope with having to comply with Dodd-Frank 1073, a piece of legislation that nobody really very well understood, but needed the full attention of banks. And I think we're in a similar conundrum right now where we have an evolving and emerging set of technologies and client demand for solutions that bank platforms really can't offer today. And so the shift is not, the shift between 2012 and 2013 and now is, that was a consumer problem. We're sort of in the commercial space here, but banks are taking it as seriously. And ultimately, that's what we're here to talk about today.
That's interesting. And what's driving this urgent need for modernization in the global payments landscape?
Well, I think it's a confluence of factors that I'd probably say would best be divided up over, 2 different phases. We just look at what's happened since Y2K. You had kind of the internet started to proliferate around the world. I mean, it was proliferating, I guess, the United States too during that time. But globalization was made possible in many ways by things in the internet when it came to small to medium-sized businesses that started to import and export. And then we had just people getting used to doing business online, right? So online banking and things of that nature. That would be phase one. I'd say that phase comprises the timeline between Y2K and year 2020. The second timeline sort of starts at 2020, and I'd say that it would best be defined as significant changes to global data standardization, like ISO 2022, the rise of fintechs, and this kind of arms race to be the provider of what amounts to the next alternative solution to what has kind of been a monopoly in the space with the way that Swift has been the go-to provider of payments. But that timeline has kind of landed us, especially set against the backdrop of post-COVID this last couple of years, where all the investments taking place in these fintechs are starting to come due. And the marketing noise is getting louder and louder, and the solution sets are ultimately getting more mature. Banks are finding themselves ill-equipped to protect what amount to the highest value payments in their bank against the rise of these fintechs that are looking to decouple payments, these high value payments, from traditional banking relationships. And this migration is actually so profound that we just have entered into a new era in what think tanks are calling the fourth era in payments. The most recent era was the account era. It started in 1990, finished in about 2020. But that account era was as plain and simple as it sounds. Account payments that were made in and out of accounts that you held with a financial institution. The decoupled era is as scary as it sounds. It is this notion that you can send a payment without having to have a bank account relationship. These payments are so valuable that countless fintech business models are designed specifically to go at this decoupled notion, and that's ultimately what the rise that is causing the fervor that is resulting in this much conversation about global payments.
And how's Derivative Path responding to these changes?
We want to help our banks protect themselves from this notion that the banking relationship as the incumbent trusted financial provider should suddenly lose out on the ability to match whatever technologies are coming that are have their sights set on these global payments. So we're here to mind the gap. Venture funding in the fintechs has outpaced all other sectors by 2 to 1. All that banks really need to do to sort of stave off some of this noise is find a technology provider that is going to help them shore up what is ultimately a massive gap in the platforms they have native to their processing environments today. And what you can do is find somebody like us who is able to sort of layer in our technology into your existing investments in a way that is actually going to help you get to market with something that is going to be as clean and as modern and as technologically advanced as what the best banks in Europe are offering their clients today, and certainly what any fintechs are offering. Ultimately, we see this market in a very different way than I think a lot of the fintechs are. That's because we come from payments backgrounds and we understand how to make a payment process within a bank operations environment a lot more efficiently. So
it sounds like a game changer. Can you expand on the integration aspect?
Our solutions are what we call an integration light. They're really not even integrations. They are deployments. So whether you are looking to deploy our technology through your cloud-based relationship with your primary online banking platform, or if we're going to use SSO architecture to slot our FX payment solution into your current customers' online banking experience in their payments menu on the left-hand side of the screen or the top of the screen, that is about the extent of the work. All of our deployments show up with APIs pre-programmed. And more importantly, instead of just becoming a solution that solves that, we need a new mousetrap because we can't continue down this branch origination path, the real kind of secret sauce, if you will, of why we're here is what we do with these payment files. Once we've shifted your point of origination into your customer's online banking experience, we take those payment files and ensure that they process in very streamlined and automated fashion into all of the bank processes that you need them to flow into without having any sort of a break in that process by integrating into your core wire platform. And it's that integration into the core wire solution that ultimately separates us from about everybody else that's out there. We want to truly digitize these payments for our clients at the point of sale and during processing. And that's something that nobody else is really able to match us with.
Excellent. Now, looking ahead, how should banks approach future-proofing their payment systems?
I'd say it should start with a call to me, but I also understand that I talk a lot. So if you'd like to talk to somebody else, or in all honesty, if you need to make an objective decision about who you'd like to partner with, take a look out there at different technology providers. Like I said, this gap has been very obvious between what your bank platforms can do and what your customers are demanding. There are a number of platforms adjacent, of which I'd say we're one, that are offering to help you kind of shore up that customer problem. We are different, and I'd say that I would encourage you to at least talk to us before entertaining any of them too much. What you'll find is that the attention to detail that we have about how to make this process truly scalable in a way where you can almost set it and forget it once we get through a little bit of implementation, that's something you're not going to see out there. No one else is taking the time to try to solve the operation side of the equation. And so talk to us and let us tell you all about it.
This has been incredibly insightful, Matt. Any final thoughts for our audience on navigating these changes?
Absolutely, Terrence. I'd say the landscape of FX payments is evolving faster today than it ever has before. What our bank clients are wanting to do and what we're helping them do is build a roadmap that gets you from what your current set of capabilities are today to where you need to be. Ultimately, where you need to be is in a defensible position that involves having a digital FX payment capability available to clients, and the ability to receive incoming payments through a very simplified means. That is what we are here to help make happen. The FX margin inherent in FX payments is kind of what's driven this massive amount of funding that has been spent on fintech business models that are trying to decouple these payments from your banking relationships. A lot of banks that we talk to at first aren't really aware of the threat because they don't think that they do enough payments to even have a department at a bank that could be considered something that a bigger bank would call global transaction banking. But the truth of the matter is, if you're north of $1 billion in assets, you probably have hundreds of millions of dollars a year that are being sent across borders in US dollars. Turning on our technology is not going to suddenly convert that into foreign exchange fee income. That's not what we're here to tell you. But your relationships that are sending those payments overseas are some of your most valuable relationships, especially the repetitive ones. Many of those US dollar international wires are being sent that way because you lack a simple and easy to use FX payment capability, and especially are missing one online. By turning this capability on, you're not only creating that possibility for the client to feel like they have options and giving them some reassurance that they're partnered up with a bank that ultimately is a very nimble and capable international banking services provider, but you are preserving one of your highest value relationships in a way where they're just going to be, they don't need a reason to think that they've outgrown you, and you're taking that off the table. There's going to be enough noise coming from all of these failed and some successful fintech venture funded business models. You want to be on the right side of your client's consideration by getting to market with something that ultimately gives them a reason to just turn the noise down. That's what we're here to help with. And I'd say just give us a call and we can talk you through how to kind of scope this opportunity and run through some of the benefits of our total solution. So that's
Great.
about all I got for you.
Well, that's wonderful. Thank you so much, Matt. And thank you to everyone who joined us today. We look forward to exploring these opportunities with you. Matt, Chris, thank you so much. We did have a couple questions that came in during the course of the event, and I wanted to ask them right now, and then also let the people know that if we don't get to your question today, we will follow up directly with you through email. The first question came in, says, do I have to find my own liquidity provider? And I think that's for Chris.
Yeah, happy to take that one. Thanks, Terrence. So we are happy to work with you if you have an existing correspondent bank that has foreign exchange capabilities, or if you do not, then we can work with you to set up a relationship with a FX dealer counterparty and help you set up the documentation and limits and lines necessary to transact in FX. So you don't necessarily have to have a relationship. If you do, we can work with them, but if you don't, we're happy to help you set one up.
Great, thank you. The next question that came in was, how do I know if I have enough FX flow to make this worth exploring? I don't know, maybe Matt or Chris.
Absolutely, I can take that one. The reality is that your clients, no matter their size, are doing a lot more international payments than you're aware. What they are probably doing much less of is foreign currency denominated payments. That is one of the statistics that makes us a bit of an outlier in this regard from countries that are members of the global economy. The United States is about the only economy on the planet where 95 to 98% of the transactions that leave our shores leave in US dollars. So what you are going to have within your customer base is a massive amount of international payments that don't look like international payments until you really dig into the wire data, but we can help you identify those. And within those, there's a subset of relationships that we can talk to you, and that we work with our banks regularly to help understand how to approach and have a conversation about whether or not they are paying a luxury tax for doing business exclusively in US dollars. The answer is going to always be yes to that question, but asking it the right way is important and something that we can help you work through.
Great. And I think we have time for one last question. Will my customers need to go to a separate portal to make international payments or hedge their currency risk?
That is one of the greatest things about our technology. I'd say, sorry, Chris, if you plan to answer this, but you absolutely do not need to enter into a different application. We have really focused on investing in making seamless transitions in your client experience between our technology and your existing bank platforms. So there is no, and while there is an integration that happens with the solutions that we deliver to the table, it is about as integration light as there is in the marketplace, and something that should be pretty much invisible to your clients for the most part. And that's true for both the hedging solutions and for the payment side. Sorry, Chris.
Chris, did you want to add anything before we wrap up?
No, I think that's great, Matt.
Wonderful. Well, we'd love to work with you. If you have any other questions, please follow up with us. You have some contact information here, and you can respond or send through any questions or inquiries to us. We look forward to working with you. Thank you so much.